E-commerce in a recession. Going to get into it and how this can impact your business as an e-commerce store owner. So naturally, the biggest thing is going to be a decline in consumer spending if this were to occur. Now, it's important to understand there are different ways to categorize and or give definition to a recession. Some people reference certain amounts of sustained decline in stock market prices. The most common used is 2 consecutive quarters of negative GDP growth in your respective country. However, there's multiple different ways. The reality is that more often than not, this leads to a decrease in consumer spending. Now, just because there's a recession doesn't mean there has to be tremendous amount of decrease in consumer spending, but normally the consumer is impacted to some degree, especially if you are having a recession that leads to some sort of consumer credit crisis, where effectively there is a kind of a lack of control on personal spending and debt. Having said all of that, though, forecasting the degree into which this could occur is obviously very difficult, but it is at least safe to assume that there is a consideration involved with how these macro headwinds perhaps can impact day-to-day business for e-commerce stores, but obviously other types of businesses as well. So firstly, in the e-commerce world, cost per acquisition / cost of acquiring a customer, regardless of what acronym you want to go with here. If you see consumer spending slow down, this will generally mean that you're going to have to spend more to acquire a customer than, say, how much you would have had to spend to acquire a customer whenever consumers were spending more. And the real reason why is because if a consumer has less discretionary income, or they have more concerns about maybe their inflation expectations for the long term are very high, therefore they choose to buy non-perishable goods in the short term to hopefully save money in the long term. So many things can impact consumer spending. Having said all that, that is one scenario or one negative impact. Another negative impact can be slower LTV payback, so lifetime value. So just for some context, this is an example cohort analysis chart, which is what we recommend businesses analyze and look at when visualizing LTV. So LTV as a metric is a little bit funny because it means forever if you use the word lifetime, but in reality you want to have a better understanding of what your customer value is over X periods of time. So for example, this is a store we work on, an arbitrary store with partially arbitrary numbers here, as every single business looks very different, but you can see new customer cost per acquisition for that time period, $105. This is monthly, by the way, 116, 111, 90, 85. And you can see the value on first order. You can see the value after the following 30-day period, 60, 90, etc. So for example, this store is an example business that actually acquires at a loss, but has phenomenal LTV. And as a byproduct of this, one thing they might be concerned about is that if you're cash flow planning, maybe you're acquiring your customers with debt, or you have limited cash on hand and you're using all of your cash on hand to mainly acquire customers. Any sort of financial planning type analysis that has to be done. One thing that can happen is perhaps instead of making, let's say you acquire customers for $100 and you need to grab roughly $130 back from them, that customer, in order to break even. Instead of this occurring after month 3, perhaps now it occurs after month 4 or month 5, because as a byproduct of people having less discretionary income, perhaps they choose to buy from you less frequently, perhaps they choose to cancel a subscription with you to save cost and open up more cash flow for themselves, whether it is to pay the higher interest they might be paying on a loan or anything of that nature whenever rates rise. So those are the two main things. So what can really be done about this? So naturally, the bigger one for most stores is the first example. And the first example basically means it is more costly to acquire a customer. And the best way to combat this is obviously continued iteration inside your ad accounts. However, arguably the path of least resistance is going to be to focus on lifetime value. Since the reality of the situation is that you are always going to make more profit from a lifetime value-based order than on acquisition. Now, there's a few caveats to this. Think a brand like Peloton as an example. Peloton with such a high average order value, and obviously Peloton is not in a great position right now financially. However, let's just assume that they had a very healthy CPA. Maybe their AOV is $2,500, they have 50% gross margins, and they acquired customers for 100 or 200 bucks. That they unlock a lot of profit in that example. Obviously, that is not true. Completely hypothetical example. And then the thing they sell people afterwards isn't as high of a value. Obviously, it's a recurring revenue based subscription model. But point being is that's kind of a caveat to this rule. But let's just say that roughly speaking, between the things people buy the first time they buy from you and second time have roughly the same value. For more stores for most stores, I should say, the second orders and third orders and fourth orders actually tend to be higher value because they now understand your brand, trust your brand, like your products, and are more comfortable to make a larger investment into the product you sell. But nonetheless, if profit is an issue now, you have a higher probability of change of meaningfully improving your odds to get more profit on the LTV side of the equation. So this is with post-purchase strategies. So a few different examples here. I'll kind of give you a few. So on this side, this is a product affinity graph, and what this is it's basically saying, and obviously all the names are blurred out for client confidentiality reasons, but this is product A. So when people come and buy the first product, whenever people buy from you the first time as a store, whenever people buy this product from you, when they come back and buy, what are they buying the most? So in this case, some are coming here, second best, third best, fourth best, etc. So what this is basically saying is that if you're putting a lot of your ad dollars behind the acquisition of 1, 2, 3, 4 SKUs, instead of pushing them down generic post-purchase sequences that can kind of sell people everything, in this situation you would actually look to build product-specific post-purchase sequences where you're trying to, based on your understanding of what people come back and buy, helping people understand kind of pushing them in that direction, as it is more likely to be that you will be able to convert them in that situation. Additionally, the other thing as well is that whenever you think about acquisition and LTV, different products tend to yield different lifetime value. And what a lot of people do is they look at their gross margins by SKU, and they use that to set their acquisition targets for different products. When if you were to look at your LTV, so this graph here is 60, 90-day LTV, and obviously you can also do cohort analysis too. But let's just, for simplicity's sake, because you want to have your payback period be 60 or 90 days whenever you're visualizing your cash conversion cycle and your minimum net margins and all that stuff. Maybe you have two products with very similar gross margins. One you have a CPA of $50 and one you have $55. So you choose to really hammer and be super aggressive on the $50 one. But what happens whenever the $55 CPA actually has a 40% 90-day LTV increase, but the $50 one only has a 10% 90-day LTV increase? Well, you're actually going to be able to yield more profits on the $55 CPA, not on day one of acquisition, but on a 90-day time window. So this kind of optimizing the business in a way where you're trying to understand, how do I strategize now, not just for acquisition-based profit, but also just holistic profit, as this often you will have more control over. Obviously, you want to try and get better returns on advertising, whether that's how you think about it as return on ad spend, new customer acquisition costs, etc. And that should always be a goal, and you should always be trying to do this. But to some degree, the marketplace itself has a lot of control over what your results are going to be. You have more control on the LTV side, arguably. Then, of course, there's also the idea of running stronger offers on acquisition. So this is not an option for every single brand. Some brands never use discounting, never use bundles, never release limited time products. But if you have, in more difficult times, if you are really trying to push either growth or profitability, a lot of brands, a lot of stores have a handful of offers that they can oftentimes go back to use. And by utilizing these offers, they know they're tried and true to work, and oftentimes work better than the, so to speak, evergreen type advertisements or campaigns or marketing calendar strategies, etc. So this is one other option as well to kind of improve performance, as even though spending may be pulled back a little bit, in theory, a tried and true temporary offer, although it may not work as good as it always does, it should work better than what you are currently doing. Lastly is point number 3, and this is the risk in pulling back spend too much. And what do I mean by this? So if we actually jump back to the previous slide here, whenever you look at this, what is happening in this business? They are spending they're spending ad dollars to acquire customers at a loss. Meaning that if you're starting to obsess over your 30-day P&L and you're trying to maximize how much profit you can get in that next 30-day window. A rational assumption would actually be to spend no money on ads, because whenever you do this, you are going to essentially just live off of your lifetime value. But there's a huge risk in this, because well, naturally, this assumes that your lifetime value-based revenue, your return customer-based revenue, is enough to cover your fixed costs and then some, assuming that you have your ad spend at zero, because then you would have no acquisition costs. Assuming this happens, yes, that might help you on a 30-day window, but if you go and analyze these cohorts over time, each and every month, there is generally a lower percentage of customers who stay and keep on coming back and back and back. Meaning that as you pull back spend too aggressively, you are effectively hurting the number of customers who are actively engaging and or purchasing in your brand, depending on how you want to look at it. And although it might have helped you for this 30-day window, it will actually hurt you the following 30 days, and then the next month chunk even more, and so on and so forth. So it's really understanding that sometimes in optimizing for a singular month's profitability during a difficult time period, it is actually still worthwhile to spend a certain amount of dollars on ads. And there's different ways to analyze how much you should be spending on ads in that certain situation. It's about understanding what your minimum volumes are to cover your expenses, of your return customer revenue, how does that cover your fixed costs, how much excess profit does that create for you, of that excess profit, can that finance the acquisition costs you're going to be doing that month at a loss. There's a lot of considerations and it's not very simple, but point being, whenever there are difficult times, it is more important than ever to understand the numbers, because if you can get through a period of time, whether it's a few weeks, a few months, or whatever, of less favorable acquisition costs, normally other brands are going through these same pain points, and if you can come out the other side stronger, you will often see less advertising competition from your competitors or other large players in the marketplace, regardless if they're your competitors, which therefore will give you lower costs and allow you to be even more aggressive. And because you had so much confidence in the data whenever times were more tough, it will only give you that much more ability to be aggressive as you look to grow, as the acquisition costs become more favorable once again. So yeah, anyways, thank you so much for listening.